and welcome to this annual update on Saints, the Scottish American investment company. I'm James Dow, the head of the Global Income Growth team at Baillie Gifford and the lead manager of Saints. How should we summarise Saints' performance in 2024? If I had to choose a single word, I would say mixed. On the positive side, our equity portfolio delivered strong earnings growth, allowing the company to raise its dividend to shareholders to 14.88p. That was growth for the full year of 5.5%, well ahead of UK inflation of 2.5%. Alongside this, the net asset value, or NAV, of the company grew to a new record high, exceeding £5.80 for the first time. Saints' objective is to deliver real dividend growth by increasing capital and growing income, and that objective was achieved in 2024. We're proud of the fact that since 1938, which was the last time Saints reduced its dividend, and also since 2003, when Baillie Gifford were appointed as the current managers, Saints has delivered dividend growth which has beaten UK inflation by an average of 3% per year. An income that grows ahead of inflation is valuable, and better still if that income is resilient through thick and thin. During the last few years, despite the challenges of a global pandemic, followed by strong increases in consumer prices, Saints' dividend has managed to keep pace with inflation. And in 2024, it was pleasing to see the dividend once again exceeding inflation by 3%, in line with the company's long-term track record. However, 2024 was not all smooth sailing. Although the NAV grew, it lagged behind the exceptional growth achieved by global equity markets by some margin. This is uncomfortable, but perhaps in some ways to be expected. The emphasis that we place on steady long-term growth in earnings and dividends means that portfolio returns are likely to lag behind during periods of market euphoria. In addition, a widening of the discount, a trend which affected the broader investment trust sector, meant the share price of Saints did not keep pace with the growth in NAV. The lag in net asset value growth was due to two main factors. The first one is Saints' relatively low exposure to the US stock market compared to the benchmark weight in global equities. This is a deliberate choice. We invest in companies with strong earnings and dividend growth prospects wherever they are located in the world. US companies typically have lower dividend payout ratios and higher valuations, resulting in less income per pound invested. By taking a more balanced geographic approach to the portfolio, compared with the global benchmark, also helps us reduce regulatory and currency risks for Saints shareholders. The other factor at play last year is the type of business that we invest in. We're focused very much on resilient long-term compounders, high-quality companies like Procter & Gamble, Atlas Copco, and Novo Nordisk. But the best performing stocks last year were the more cyclical ones, such as banks, and so-called big tech companies, such as the car maker Tesla. These are not a good fit for our clients, who expect dependable income growth and want to sleep well at night. While approximately 90% of Saints is invested in equities, we invest another 10% of the portfolio in other income-generating assets. Our property portfolio had a good year, with a total return of about 8% despite the challenging backdrop of rising interest rates. Recent acquisitions by the property manager have raised the proportion of leases linked to inflation. And these, like all our investments, can be read about in more detail in this year's annual report. It's also worth saying that our infrastructure investments too continued to deliver solid income growth. We made several changes to the equity portfolio last year. We divested from a handful of companies, including GlaxoSmithKline, Sonic Healthcare, and Dolby Laboratories. All had been solid investments for Saints, but in the years ahead, we foresee structural headwinds and lackluster growth. We use the proceeds of those sales to invest in more exciting new businesses, which we expect to underpin dividend growth in the years ahead. The first was Epiroc, a Swedish powerhouse in mining and construction equipment. It's at the forefront of innovation and growth drivers such as the automation and electrification of mining. It's well managed by people who think long term, and they are committed to progressive dividend growth. We also added CME Group to the portfolio. CME is the dominant exchange for the trade of derivatives in the US. It's the go-to for everything from interest rate futures to corn contracts. As the financial world gets more and more complex and risky, and increasing numbers of people are seeking to hedge these risks, this is likely to translate into growing profits and dividends for Saints shareholders. Our third addition was Paychex, an American company that makes life easier for small business owners. Their core business is payroll processing, but they're expanding into areas like health insurance and recruitment tools. It's really a classic example of a company with a strong base that's finding new ways to keep compounding its earnings and dividends. So what's the bottom line for Saints shareholders? Well, 2024 presented a mixed bag in terms of the relative performance of Saints shares, while income and NAV growth was robust. As we look forward, we remain very optimistic about Saints' prospects for three reasons. First, we've seen continued solid dividend growth from Saints' portfolio holdings over the past few years, which to us is strong evidence that the underlying portfolio is healthy. We continue to find interesting new ideas around the world, giving shareholders access to high-quality businesses with good prospects for capital and income growth. Second, the portfolio remains well diversified. While some parts of the global stock market, particularly the US, are looking quite frothy with high expectations baked in, Saints remains broadly diversified globally across a selection of growing companies with resilient business models and reasonable valuations. Finally, it's our firm belief that an income backed by natural dividend growth, the Saints approach, is a compelling way to deliver a resilient, progressive income that beats inflation over the long term. This approach has been tested over many decades, and particularly at a time when the world is looking increasingly volatile, we hope this gives a lot of reassurance to shareholders. Saints shares are currently trading at a significant discount to NAV, and for me, this only adds to their attraction as a potential source of long-term income and capital growth. As 2025 gets fully underway, we remain committed to Saints' objective: a growing and resilient income that beats inflation while growing capital and extending Saints' long-term track record for years into the future.